Let's take a look at in the money covered calls. I did one of these last week, purchased 100 shares of SOXL at 35.22, and I did a strike price of less than my cost at 32.50. And of course, I was assigned because these were in the money. I received $300 in premium for that, and I gave these away for a loss of 272. So I ended up with 48. And we'll get into the details, but let's first look at what a typical covered call looks like, where you do out of the money covered calls. So if I do the same stock, SOXL, today is Sunday the 27th. If I go out to this following Friday, and I go sell call. Let's say I pick these up at 35.19 current price, and typically you would want to choose a strike price that is above the share price, and that is out of the money. So if I just select this $37 strike price, I would get $1 per share times 100 shares. That's $100. And what does that mean to be in the money or out of the money? Well, if the price goes up to 37 or higher, then this option would be in the money. And you have to take a point of view as the option buyer. So if the option buyer bought this, they're hoping that the stock's going to go above 37, and they've paid a premium of $1 per share for that. So if it does go higher than that, then for them, they are in the money. And for me as a seller, if I purchase these at 35.19, I'm making some appreciation from that price to the 37, plus I got the premium. But from the buyer's perspective, they're in the money if the stock price goes above 37. If it stays below 37, then it's out of the money, and I keep the premium and I keep my shares, and I can do this again. Well, sometimes it makes sense to go sell an in the money covered call. So I've got this example in a sheet, 35.19. Got that right here, cost per share 35.19. Made this sheet yesterday, so it expires 11/1, just like we talked about. And so date's expiration 6. And I was doing 5 contracts, so the total capital to purchase these would be 17,595. That's 500 shares times 35.19. So let's say I go in the money and I sold a call at 33. I'd get paid a much higher premium for that, which is $3.15 per share, or $315. So I've got the premium right here, and part of that is intrinsic, which is the difference between my cost and my strike price. So 35.19 minus 33, that's 219. But I was paid 315, so the difference between 315 and 219 is 96, and that is the extrinsic or time value. So that's 96 cents per share, or $96, and that's my profit. So 96 cents times 5 contracts is $4.80 profit per share. So total profit times 100 is 480. That's a 2.73% return in 6 days. If I extrapolate that out for a year, that's 165% per year. So why would you want to do this? Well, the premium is a lot higher when it's in the money, and it offers you some downside protection. So if the market you think is going to start turning bearish, then the stock can go down from 35.19, which is your cost, down to 33, and you still make all that premium. And so this delta is pretty high. There's a 71% chance that the shares are going to get called away, and that's okay. We can do this over and over again. However, if the stock does go down below 33, then it'll be out of the money, and I can keep these shares. And what that does is it reduces my cost basis down to the strike price. So if I look at this, if I take 35.19, which is my cost per share, I've been paid $219 for that, which brings it down, my cost down to 33, and then my profit would be 96. So my new cost of acquisition on these is now 33. If that expiration, the price is below this, I'll keep the shares. It'll expire worthless, and now my cost is 33, and I can go sell a call at this strike price at 33. So that's a little bit of downside protection. If the market turns on you a little bit, goes down to 33, you could still make great premium because the market's now down around this area, and it's more likely to go up. So now you can sell a call that is maybe higher than 33. get some appreciation. So I could make $1 going from 33 to 34. And if I was doing this today, I could collect $2.51 the next week. So I like to do these short expiration of a week, and that allows me to have time decay in my favor. The shares are expected to be called away, but if they don't, you've got some good protection there, and you can make more premium by keeping the shares and selling them at a lower cost. And the best time to trade these is like maybe the Thursday or Friday before the next Friday expiration, because you don't have that extra time decay of the Friday to the Monday, and things could happen between them. It gives you extra days to line this up. And so it's just kind of a tool to use in your toolkit if you think the market's going to start turning bearish. So let's try some different scenarios and try to optimize the profits that we can make from this by choosing different strike prices. So this is at a strike price of 33. If I went to back to SOXL and I do trade options, sell, call, expiring November 1st, and I go to 34, that would give me a $251 premium. So if I plug this in, copy this line, same cost, 34, and the premium is 251. That puts my intrinsic value at $1.19 and my extrinsic at 132. So the total premium is 251. So if I take 35.19 minus 34, that gives me $1.19 as the difference. That's my intrinsic value. I would get paid $251, so the leftover is my time value of $132. So that would be my profit. Profit per share on 5 contracts would be $660 and a 3.75 return. So I would probably want to do this trade instead. Let's try a different one. Let's go down to a $32 strike price. So this would be a premium of $3.90. Copy this line. So there's less premium there. If I take $35.19, my cost, subtract 32, that gives me $3.19 of intrinsic value. Again, the premium is $3.90, so $3.90 minus $3.19 is 71 extrinsic or time value, and that would mean my profit per share is $3.55 on 5 contracts, and the total profit would be $3.55. So it looks like, this $34 strike price would be the optimal in this situation. So what you can do is just take a spreadsheet, put these numbers in, and play around with it, and see what would be best for you based on your goals. So I'm probably going to make this trade on Monday. We'll see how the numbers line up. These are the numbers that kind of locked in Friday and been sitting here over the weekend. So I don't know if things will probably change when the market opens up on Monday, but I'm going to look at this and optimize my choice and probably do another in the money covered call on SOXL. And that's it for this video. I hope you got some value out of it. If you did, make sure to hit that like button and subscribe. And I got a lot more videos coming out this year, and I'm excited about it. And we'll see you on the next one. Thanks, bye.